Hello, and thank you for joining me for The Wisdom of Wealth, a show where we help educate Canadians about fundamental financial literacy topics to help you make better and more informed decisions and to know when and where to reach out for help. I'm your host, Jason Pereira. Today on The Wisdom of Wealth, we are going to talk about something that we all have to deal with, no matter how much we wish we didn't: tax. The old saying that the only thing certain in life is death and taxes is still very true, especially if you live in Canada. There are three general types of taxes around the world: taxes on income, taxes on consumption, and taxes on assets. In Canada, we have some form of all three, and we're going to talk about each of them today. And they can all add up. In fact, the Fraser Institute estimates that the average Canadian household spends about 43% of their income on various forms of taxation for an average of $37,000 a year, making it the single biggest household expense. Understanding how taxes work and how to do some basic tax planning can help you be mindful of that bill. So let's get started with the biggest form of tax: income tax. Income tax is the primary form of tax Canadians pay. The concept is pretty simple. You make money and you pay a percentage of it in taxes. But the more you make, the more you pay. But that percentage is different based on your income. Canada employs what is known as a marginal or progressive tax system. This means that certain tax brackets apply to certain amounts. To explain this, let's look at a very simple example. Let's say you make $75,000 in a year. And let's imagine that you have it all in your hand right now when the tax man comes. The first thing you'll have to do is put the money onto a table in smaller piles based on the amounts that the tax man tells you. So they'll tell you to put the first $10,000 in the first pile, the next $20,000 in the second pile, the next $30,000 in the third pile, and then the rest of it in the last one. Now, the tax man then comes along and looks at the first pile and says, okay, I'm going to take nothing from this, 0%. Then they come along to the second pile and they take 20%, or $4,000. The third pile, they'll take 30%, $9,000. And the fourth, 40% from the last pile. The rate goes up as you move down the line. This is a concept known as tax brackets. As you make more money, you reach what the government limits allow you to pay in tax on that amount of money. And then you have to start on the new pile. And as you move down the line, the rates get bigger and bigger. This applies to all Canadians. No matter how much you make, all Canadians benefit from the lower tax brackets, while higher income earners pay the higher tax brackets. The end result is that those who make more pay more, and they do more at a faster and faster rate. Your last tax bracket is known as your marginal rate. This tells you how much tax you'll pay if you earn another dollar of income. In our example, the last rate was 40%. So that means if you earn another dollar, you're going to pay 40 cents in tax. Now in our example, the total tax bill was actually $19,000. And when you divide that by 75, you'll find that equals 25.33%. This is what is known as your average tax rate, what you actually pay as a total in tax. So let's stop and review this. The marginal tells you how much you pay in the next dollar, whereas the average tells you what it is you actually paid. Now, that was a simple example, but let's talk now about how tax rates actually look. Every province is different, but in Ontario, the first $10,582 of income is tax-free no matter how much you make. It doesn't matter if you're working part-time at McDonald's or if you're a professional athlete. You pay $0 on the first $10,582. After that point, income starts becoming subject to tax and increases up the 12 different tax brackets in Ontario that start as low as 5.05% to a maximum of 53.53 on every dollar you earn over 220. Yes, there is a point that if you start making more than a certain amount, the government keeps more than what you keep. And that's a story similar across over half of Canadian provinces where tax rates exceed 50%. When people don't understand the difference between average and marginal tax rates, they sometimes fear that a raise will mean that all of their income is taxed at a new higher rate. That is never the case. You still benefit from lower tax brackets. It's just that the new money gets taxed at the higher rate. Now that we've covered basic forms of income tax, let's talk about other forms. Specifically, what happens when you invest in Canada? When you invest in Canada, you pay income tax on the returns, and that depends on the form of return. And unless you hold that money in an RSP, TFSA, RESP, or RDSP, all income is subject to tax. We're going to cover all those accounts in future episodes. So to start, let's say that you buy something, a stock or rental property, whatever it might be, and you sell it for a profit. This profit's what's known as a capital gain. Currently in Canada, capital gains are only half taxable. So that means if you had a $100,000 profit, only $50,000 will be added to your income. Another form of income is known as dividends. This is when you own shares in a company. Some companies will pay a portion of their profit to shareholders. This is what's known as a dividend, as I mentioned. The tax rates on this are based on a bit of a formula that's a little bit hard to grasp, but it does result in lower tax than regular income when it's from a Canadian company. If the company you own is publicly traded, that is to say that it trades on a stock exchange in Canada, then the maximum tax rate on these dividends is 39.34% versus the 53% that you're paying on normal income. If the company's private, the top rate's 47.4%. All other forms of income, whether it be interest, rental income, or dividends from foreign companies, are taxed at your normal tax rate of 53%. Now you're probably thinking that was a lot to take in. And even as simple as I made it, it's really complex when you really think about it. So these rates and brackets change and they vary from time to time, and they vary from province to province. A qualified accountant and financial advisor can help you both understand the tax rates and how the tax system works and how to minimize your tax bill. Consumption taxes are charged on purchases of goods and services when you buy them. This is also known as a sales tax. In Canada, this tax takes the form of a provincial sales tax, federal goods and services taxes, or when they're combined, the harmonized sales tax, or HST. The math is pretty straightforward. You buy something, and you take the sales price and multiply it by the tax rate. It doesn't matter how expensive the product is, the percentage never changes. The percentage depends on the province you live in, and it ranges from as low as 5% in Alberta to as high as 15% in various provinces. Now, fair warning, in the last election, there were promises made about a luxury tax of 10% on big ticket items, like boats and cars. So if you're looking to buy a boat, you might want to move fast. Now, let's talk about the last form of tax, asset-based taxes. There are various forms of asset-based taxes around the world. These are basically a percentage charged on the value of something you own just because you own it. There are not many of these in Canada, but the most common one known is property tax. Everyone who owns a house knows about this. The amount is paid annually based on a percentage times the value or assessed value of your home. Another form of this is probate. In some provinces, when you die, a nominal amount is charged based on the amount of the estate in the will. Depending on the province, this can be nothing, a flat fee, or a very low single-digit percentage. In other countries, there are other forms of this type of tax. Inheritance and estate taxes, gift taxes, even wealth taxes on your entire net worth. Luckily in Canada, we don't have any of these, well, yet. So those are the three basic forms of taxes and how they work in Canada. And yes, it is definitely complicated. And to help discuss what can be done to manage your tax burden and potentially lessen it, I've invited an accountant, Leanne LaRose of Cranes LaRose, to join me in studio today. So today in the studio, we have Leanne LaRose of Cranes LaRose. Leanne, thank you for joining us.
Oh, thanks, Jason, for having me.
My pleasure. So Leanne, tell us what it is you do.
Well, I'm an accountant, and I usually practice tax, and I work with owner-managed businesses, self-employed people, commissions, agents, you know, various. You
take care of the scary tax.
Yeah,
tax. Exactly.
Hopefully.
Hopefully. Okay, so first off, let's talk about people's responsibilities around taxation. Now, it's on the individual to know that they have to file, and they have to file by certain deadlines. What do they have to do to be in line with government regulations?
So the filing deadline is April 30th,
and
it's coming up. Yes, one of the common miscommunications I find with self-employed people is they do have a filing obligation that is extended to June 15th. However, the tax is still due by April 30th.
Yeah, so
a lot of people think you've got to pay it,
Yeah.
and a lot of times you need to figure it out before you know. So I encourage my clients to come in for April 30th, because if you've got to pay the tax, you might as well determine how much that is.
It seems backwards, right?
Yeah.
Like you have to, you basically tell the government how much you owe, or you think you owe, after you've actually paid it, which is quite amusing. So pretty straightforward. So I'm sure that you have encountered on countless occasions clients coming in with all their paperwork and saying, okay, here's my stuff, make me pay no tax, work your voodoo magic, and that's just not possible, right?
It's not possible, especially if they are an employee and there's not much we can do. There's not a lot of tax planning involved. It actually can't be done at that time. As you know, Jason, the best tax deduction would be your RSP. And if you haven't done that by February 29th, then you're probably not going to. In a leap year, which is this year.
Yeah, but and besides, the reality is that we're being taxed on the previous year. So the RSP is different because it allows us to do something in the current year. But if you haven't done it in the previous year, it doesn't count. Right? So once people have come in and you've explained that you're not a wizard and you can't make their tax situation disappear, and you want to educate them as to how they can minimize their taxes going forward, what types of solutions exist?
Well, I ask a lot of questions, so I get to know my client, to know what their situation looks like, because sometimes they don't know what they don't know.
Exactly.
Whereas I do. So I concentrate on tax credits versus deductions because there's very little deductions out there these days.
So let's talk about the difference between those two.
Okay.
So deductions. What's a deduction?
A deduction is something, a legitimate tax deduction that we take against our gross income. And therefore, it actually, when you were talking about marginal rates, the deduction occurs at whatever your top marginal rate is that you are preparing your tax.
So I made $100,000 the previous year. I have a deduction for $10,000. So now I'm really making $90,000.
Exactly.
But they collected on $100,000. So I basically, if my tax rate's 40, 10 times 40, $4,000 in tax savings.
Exactly.
Okay.
Whereas a tax credit is usually a credit, in most cases, at the lowest tax bracket. So medical expense, for example, there's a couple contingencies on that, which I can get to when we talk more in depth on medical expenses. But that would be a tax credit more at like the 29% tax rate, which is your minimum rate.
You spend $1,000 on medical expenses, right? People often think that a tax credit means that they don't pay that in tax, right?
Yes.
Unfortunately, I have broken many people's hearts by saying, sorry, that's not how it works, right? So that tax credit is applied to a certain rate, usually the bottom rate, 15% federally, and you save on that $1,000 up to $150, right? So you're at least saving tax, but it's not wiping out the same amount, right? And people get confused by that. I spent this, why am I paying that? Well, it's not one for one. So there's not many deductions. Tell us what deductions do exist.
So for the average person that has employment income and young family, husband and wife both working, they have childcare expenses. The limit for childcare expenses, yes, you probably paid $25,000 or $30,000 for your daycare or your nanny, but it's not all a deduction. The maximum deduction would be $5,000 for children under the age of 6, assuming that they're not at full-time school, and then, $7,000 for children under 6 and $5,000 for children over the age of 6.
So there's a limit on how much you can do.
There's a limit on how much you can do, but it is a deduction. The other caveat is it's a deduction by the lower income spouse, unless, and then there's some caveats as to when the higher income spouse can actually claim that deduction. Other deductions, such as professional dues,
like union dues or
dues for your profession that you need to maintain in order to continue to act in your profession.
Like a lawyer or accountant.
Yes, if your employer doesn't pay them on your behalf. And investment management fees. If you have a portfolio where you require an investment advisor to manage that portfolio and you're paying a fee on that and earn investment income, you would be able
only on non-RSP TFSA. Like it's gotta be taxable.
Not the registered accounts.
Okay.
And certain legal fees for certain reasons would be a tax deduction.
But not fighting traffic tickets, right?
No, you can't. No,
okay.
Definitely not.
So that's the deductions. Now let's talk about credits. What sort of credits exist out there?
Well, we all have our personal credit, which you mentioned in your...
The 10,000.
10,000 provincially, 12,000 federal, 12,000 and change federally. There is an age credit for people over the age of 65. However, as your income increases, they take it away. Taken away. And there are disability tax credits for oneself or for a dependent that you have. The dependent under the age of 18 that has no income.
Yeah,
You
and
would
this is
get
an
tax
important
credits. Very important, but
Yeah.
it's very complicated.
It is complicated, but also very underused. We're going to have an episode about this specifically in the future, but it's anyone who's got any kind of ongoing care for some sort of disability really needs to look to file for one of these.
And interesting, there's deductions and credits and medical expenses that could actually be used and claimed for that dependent child in many different ways. So I can give you an example of where you could claim a deduction for a disabled child, for example, that's under the age of 18, where you have a live-in caregiver, for example, and you're paying that caregiver maybe $50,000 a year to manage and help you with your disabled child. You would get your $10,000 child care deduction because it increases to $10,000 for a disabled child, and then you still paid 40 or 50, you might be able to claim a medical expense for the difference because there is a reason why you need that caregiver.
So it sounds complicated.
It's
It is
complicated.
This is why, again, professionals get paid for what they do, because you're going to have to sit down with your clients, like you said, like understand them, ask all kinds of questions, because the things that they're doing in their day-to-day life, some of them they think are appropriate for taxes or applicable to taxes, and others they just don't even stop to think that they apply. Right?
Exactly.
And the most lucrative tax credit, which is one that we plan around a lot, is the charitable tax credit. How much do we save on making a charitable donation?
Well, interesting. We talked about credits being at the lowest bracket. There's been a massive surge, obviously, to encourage people to donate. So you actually, the more you donate, you can go up to the highest credit, or one of the highest credits, up to 40% or so.
Yeah, so I basically give $1,000 in charity, I can save $400 in tax.
Yeah. And there's also an amazing double dip, we say, where if you actually donate it, shares in kind, for instance. If you have shares,
I bought something at $100, it's at $150. There's a gain there.
There's a gain you can avoid. I would pay tax,
but I can avoid the gain now.
You avoid the gain if you donate the stock. You'll get a donation receipt for the fair market value of that stock. And you don't have to report the capital gain. So it's actually a double benefit if you wanted to donate stocks with accumulated gains.
It's funny because people often ask me, like, oh, I've got this big capital gain, how do I not pay tax on it? Give it away.
Give it away, yeah. And then you'll get a tax credit.
But that's how there's no answer. Like you can't get away from it. So that's the big one. Now those are deductions and credits. Let's talk about responsibilities beyond what we talked about. So for example, what happens if you own property in a foreign country, or basically a rental property or just another home?
Okay, so we have foreign property reporting rules reported on a separate form, and it has definite reporting deadline. So one of the things I always tell my clients, even if you think you're getting a refund, so you're not going to file by April 30th, if you actually have foreign property, make sure you file on time, because elections have penalties for not filing on time, even though there's no tax implications.
And what are those penalties?
Off the top of my head, I don't know, it could be up to $10,000 for late filed foreign property.
Wow. Yeah.
It's quite significant.
Yeah.
I think I've seen some at $2,000, so depending on the length of time, it might be $100 a day or $100 a month. Sorry, I don't have that off the top of my head.
But still, it's pretty significant.
So it's important. The key thing is it's foreign property. A lot of people think, oh, I don't have anything outside of the country. And it's foreign property in excess of $100,000 cost base in Canadian dollars. And foreign property includes shares in trading on a foreign exchange that you're holding with your Canadian broker.
So I bought Apple or Microsoft, and I paid 60 some odd thousand Canadian for it. So I paid 100,000 Canadian or 60 some odd thousand US. I think of it as 60,000 US, but really it's over 100,000 Canadian. I got to report that.
You've got to report. Yeah. Now it's not a tax obligation, it's just a reporting obligation, but it's really important that you understand that. If you are just investing with a Canadian broker, they know how to produce the reports, and we have to be conscious. It's one of our questions we ask our clients as we get to know them. Interesting, you asked about a difference between a rental property, foreign rental property, and a foreign home. Now, if you have a foreign property, but you use it personally, you do not rent it out, so you have that condo in Florida or whatever, that's not foreign reportable property because you're not renting it.
It's not an investment.
It's not an investment. Yeah. But if you actually use it personally and rent it, then you are triggering foreign property
So let's talk about that. Let's debunk a myth out there. People hear the term offshore all the time, right? And they assume that there's this magical way that you can not pay taxes if your assets are outside the country. So what's the reality of the situation?
The reality is you pay tax in Canada on your worldwide income.
Yeah.
In Canada, we pay tax based on residency. So if you're a resident of Canada, you pay tax on your worldwide income. Therefore, if you have
if you're not doing that, if you're not
reporting the income that you're earning on your UK bank account or whatever, you really should.
Yeah.
And you might consider a voluntary disclosure to look at
anything that you forgot about doing.
Yes.
You forgot about doing. And here's the thing I will tell people, like, how are they going to find out? They are getting really good at finding out. Like, countries are sharing information left, right, and center now because, it's not one country who's got a problem with, only their citizens doing it in their country. People are basically hiding money or having money outside of their country. So the UK may have residents who have assets in the US and they're not declaring them in the UK, right? That's not a tax haven, but the UK wants to know about that, right? And the Americans retrospectively want to know about the Americans in the UK. So they're swapping data. So this is not a smart move to make going forward.
Right. And a lot of times it's really just not knowing the rules. It's not because somebody doesn't want to report. They don't understand
exactly
what they have.
Or they rented it out for 2 weeks. They didn't even think of it, right? Like it's small. So there's one unique situation though, based on where you were born, and that's if you're an American citizen or an American taxpayer. There's a different set of obligations. What are those obligations?
So if you are an American citizen living in Canada and working in Canada, you still have now the U.S. tax is based on citizenship, not on residency. So irrelevant of whether you're a resident of the U.S., you still are obligated.
Doesn't matter where I live. I could live in Canada. I could live in Zimbabwe. It doesn't matter. I'm always reporting to the U.S.
You have to file. And a U.S. person is defined by a U.S. citizen, a U.S. green card holder. So
possibly children of American citizens sometimes.
That have So you do have to make sure. I think that all of those filing obligations might be outside of the realm of this, but you just be aware if you are a U.S. person, you do have obligatory filing obligations in the U.S. So
I'm an American citizen living in Canada. I have to file in the U.S. and Canada at the same time. Am I worse off for this?
9 times out of 10, you don't actually owe tax in the U.S., right? Canada has a higher tax rate than the U.S., so there's no such thing as double taxation.
Yeah.
So if you've paid your tax in Canada, the likelihood of you owing tax in the U.S. is very, very small.
Yeah, so if...
there's the difference would happen, maybe we pay tax on only half of our capital gains.
Yeah,
so
there's some differences.
There might be some differences, but it's rare.
But let's go back to double taxation. If for whatever reason I'm in another country or my assets are in another country, and I pay tax on that income, and then I have to declare that income in Canada, what happens?
If you've filed a foreign return to report that specific income, the tax that you paid on that tax return, we would 9 times out of 10 under the treaties be able to take a tax credit in Canada on taxes paid outside of the country. So you're only paying the differential. So if Canada's a higher taxed country, you'll pay the differential. If Canada's a lower tax country, you're not getting any more tax back in Canada. You just don't have to pay any additional tax on that.
So it's a simple example. Let's say that I earned $5,000 in a foreign jurisdiction, and in Canada, when I file my tax returns, all my worldwide income equals $20,000 in income. Well, basically, I wouldn't pay $25,000, right? I would pay 15 in Canada, 5 in the foreign jurisdiction for a total of 20. If, for whatever reason, the tax rate is higher in the foreign country, then Canada's not going to turn around and tax me at the higher amount. They're just going to, again, offset whatever I paid here. Yeah. Good. So people are often scared about that, saying, why am I paying there and here? I'm getting screwed. Everybody always, the term screwed gets used a lot when it comes to taxation, but essentially that's not the case.
They try to be,
they try.
Try to make sure that we don't have double taxation in many cases.
So before we wrap up, what are some just basic tips on how people should deal with their filing obligations and what they can do in advance of the year end to basically maybe make sure they're in order or minimize their tax bill?
So I know we talked about credits. There's a couple other credits that a lot of people ask about, and that would be their children's tuition.
Yeah.
You have kids in university and they're and you want to file their tax return because you need to report their university and their tuition on their return. And if the child agrees, they can transfer some of the tuition credits to a parent if they don't need them.
Yeah.
And they can transfer up to a maximum of $5,000 of the tuition. The balance, if the child doesn't use those credits, in fact, the child will use them in the future and they can carry them forward. So a lot of times the kid says, oh, I don't know any tax, I'm not going to file a tax return. So we really encourage...
Mom and dad owe tax, it's time to give them a break.
But we encourage the kids to file their returns so they can accumulate their tax deferral for their in the future. They can get their GST rebates and their Trillium credits if they actually are paying rent and at
so
university.
There's actual benefits coming back to them.
And of course, as you can appreciate, if they've made $5,000 at their part-time job in the summer, they're accumulating RSP contribution room to use in the future. Yeah. So they're kids that are in university over the age of 18 that don't owe tax should still file their tax returns.
Well, it's funny you mentioned that. Like I hear this all the time. Well, I haven't filed my tax return, but I don't owe anything. It's fine. Well, if you don't owe anything, odds are the government owes you money, and you're just giving them an interest-free loan until you decide to actually get your paperwork done.
And in fact, they're being more strict on statute-barred returns. So if you haven't filed for 10 years and you have refunds, they're going to stop. They might not.
So you might lose your refunds.
Your refund back 10 years or whatever.
Wow.
Like statute-barred might say, listen, I'm sorry, you're negligent. I'm not giving you your refund. So
yeah, this loan has become a permanent donation.
Exactly.
Oh wow, with no tax deduction for it. So lovely. So great. So make sure you're aware of the credits. I think basically talk to a professional.
File your tax return. It's not as scary as everybody worries about, and I think it'll give you more. Let you sleep easier at night knowing that it's filed versus worrying about it and accumulating the stress of not
And in
filing.
fairness, on the personal side, they've really done a lot to make it a lot easier in the last couple of years, right?
Yeah.
Now, one last thing to touch upon before we finish up. When does it make sense for someone who can create a incorporation as a business, a self-employed person, when does it make sense for them to do that?
It makes sense to incorporate, assuming that all the other criteria are I usually do a decision tree when somebody's incorporating because they actually are starting a legitimate business. Question one, can you be sued?
Yeah,
yes.
Liability is one thing, yeah.
Incorporate irrelevant of my next tax question.
So the important thing being that if you are conducting business under a corporation and you get sued, the corporation gets sued, not you personally.
Right, so there's unless you're a professional,
yes,
which exempts
doctors are not exempt from that.
Right, neither am I.
Yeah, fair enough.
So what you have to do is say, do I need all the money that I'm making? I think that's the biggest decision to make because a lot of people say, I'm going to incorporate because it's a lower tax bracket and it's got more deductions.
Deductions are the same, really.
The deductions are the same. If you're running a business expense is a business expense. It doesn't change because you're incorporated or not incorporated. So that doesn't matter. Yeah. And the tax rate's not lower if you need all the money you make because the corporation's a separate legal entity. So if you pull the money out of the corporation, it's like you're an employee of the corporation. It goes all on a T4 to you, so you're better off. The benefit to being incorporated when you're running a business is the tax deferral of not needing all of the money.
So if I don't need all the money, I can leave it in there.
Tax
and then
at
later
a low,
on,
potentially later, you'll pay the balance of the tax.
Or even if I take, I have a bad year, I can draw the money out then at a lower tax rate. And when I talked earlier about tax rates on private businesses, people look at that and say, well, I'd rather pay that than 53, but they forget that the corporation paid tax on that money first. And by the time you had the corporate tax bill plus what you paid, it's 53 at the top line.
It truly is. And that's the other thing is tax on dividends is lower because the corporation has already paid the first level of tax. So we love getting dividends from our portfolio stock from whether it's Bell Canada or Trans Canada. You get your dividends on that. You're only paying your 39% tax.
But the corporation pays tax.
But you don't own that corporation. Yeah. Once it's a private corporation, you own it. You're paying the tax at both levels. You're paying the corporate tax. You are the corporation. So you're paying that first level and the second level of tax. So what we try to do is plan when it is best to pay that tax.
Yeah, and there's a lot of misgivings and people thinking that, people who have businesses get to do all this wonderful stuff and pay less tax. The answer is not the way the Canadian system's built.
Yeah.
There might be a slight delay of that taxation,
But it still will be paid.
It's still coming home,
Ultimately
right?
will be paid, yes.
Good. So now that we've covered all that, thank you very much for helping shed light on that. And where can people find you?
I'm in Toronto, and our firm is Creans LaRose LLP. We have our office in the Beaches area of Toronto.
Excellent. And they can just Google you and find you there.
Google me.
Excellent. Well, thank you very much for taking the time.
Thank you.
Thank you all for taking the time to join us yet again on The Wisdom of Wealth. Hope you've learned a little bit about tax today. Hope it's made you less afraid of the subject, and hope that we've informed you as to your obligations and your options. So, as always, we hope to increase your financial literacy little by little, and I think we did that today. Thank you yet again for joining us, and please join us again in the future.